Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to the stream. So I hope everyone is doing well. Big day today. We do have the Fed meeting, okay? So if you guys are not aware, in TradingView you can have these small little bubbles and it tells you the breaking news of the day. So you have the Fed press conference, you have the economic projections, and you have the interest rate decision. I would say this is the most important news event as far as scheduled news events go. So we don't expect anything to happen with the interest rate decision. So we expect the interest rate to remain the same. What we're focusing on for today is going to be the economic projections. So projections for the future, okay? Projections of the interest rate. Is it gonna go down more? Is it gonna stay steady? Maybe they will raise it. I don't expect them to raise it at all. But what is currently projected is 2 rate cuts in 2025. Okay, so we're getting these new economic projections, and possibly the Fed will be more eager to cut rates. Okay, so maybe we will get 3 cuts in 2025, or maybe we will get more cuts in 2026. That's why the projections are very important. And then you have the press conference half an hour later after the interest rate decision, which is again a very important news event because you have Powell coming on, the chairman of the Fed, and then you're trying to assess from his speech, is he more hawkish? Is he more dovish? Is he neutral? Is he concerned about tariffs? Is he concerned about inflation? Is he concerned about the jobs numbers? Okay, so you're trying to decipher what is Powell thinking, and then that has an impact in the markets. Let me give you like a general rule. So if the Fed cuts interest rates, so if interest rates go down, well, that means that the dollar should lose value. Okay, so we can go to the DXY. We can take a look at the dollar. So if the Fed is more eager to cut interest rates, the rule is that the dollar should go down. Okay, this is the DXY. It measures the strength of the US dollar relative to other currencies. And the stock market should gain some value, okay? Because if the interest rates get lower, that means the economy should expand, which is positive for US companies, which is positive for the stock market. If the Fed remains with the current interest rate level, okay? So if the Fed remains with the current 4.5 rate level for, let's say, the whole 2025, then that's kind of a hawkish scenario. In a hawkish scenario, you would expect the dollar to actually gain value. Okay, so you would expect the DXY to go to the upside. You would expect the dollar to go up. Stock market, well, it's kind of negative. That's kind of bearish for the stock market because high interest rates make the economy contract, which is not the best thing for US companies. So that's kind of what's going on. If you have any questions about that, put it in the chat. Now I'm going to break down some of the trades that I'm personally in, some of the things that I'm personally watching. And if you guys have any requests, any chart requests, any questions, make sure to put it in the chat. I have the chat open on the side. So let's get into it. First, this is my watch list for the fundamental strategy. Very similar to how Nick trades. So I'm looking at the edge finder. I'm looking at technical analysis. I'm looking at the daily chart, 4-hour chart and the hourly chart to find entries. So I have NJ to buy, I have the DAX to buy, I have the pound dollar, I have the NASDAQ, and I have silver. Those are my top picks for today. So let's start with the New Zealand yen. Okay, so we have the DAX, we have gold in the chat. Okay, sure, we'll take a look at all of that. NJ, I'm in a buy setup all the way from the 22nd of May. Now, this has been a very nice setup, very nice trade. Edge Finder was very bullish. Technical analysis was good. I found a nice entry here on the 22nd, and I've been holding it all the way from the 22nd. I took half of my position off when we reached this high right here, and the rest of the position is getting a trailing stop loss. Okay, so if the market does decide to continue grinding higher on the daily chart, I will just keep trailing the stop loss on the daily chart. Currently, my stop loss is around here for the rest of the position. Okay, so already had like a 3-to-1 on the first half. Let's see for the second half, maybe I'll get taken out for a smaller profit. Maybe the price will continue all the way to these highs, to this resistance level. I'm trailing the stop loss and I'm seeing what will happen. So NJ, I'm not looking to add more positions. I'm just kind of holding this one. It's very bullish because the New Zealand dollar has been getting some good economic data. Also, current market environment, which is something you always have to ask yourself. So what is the current market environment doing? Current market environment, in my opinion, is still risk on. So that is bullish for the stock market, especially the US stock market. We have just been shooting to the upside. We have just been grinding higher. So that's a very good sign. Now, in line with that, I'm also long on the DAX. So I'm also long on the German 40 top German companies. Again, so we retested this level right here. We're getting some very steady data out of Europe. So if you're looking at economic data, we're beating expectations. Inflation is cooling as well. If I remember correctly, I have to check the Edge Finder, but I do think inflation is cooling as well. And that is all creating a bullish environment. So a bullish environment for the German stock market. And that's why I took an entry right here. Technical analysis, we have just been grinding higher with a lot of force. Okay, just grinding higher with a lot of force. And now we're pulling back. Again, I don't really want to be buying straight on these highs. So we pulled back a little bit and I found a nice break and retest entry. Very simple stuff. Price kind of went up here with momentum, pulled back, and then I got in with a retest of the level. The entry doesn't have to be clean at all. And now we're in a bit of a drawdown. So holding this position, part of the game, part of the probabilities, fits my plan. So I decided to get in. I think Nick is in this trade as well at a similar level. So it's getting a really bullish bias on the Edge Finder. That's my main reason to take it, because we're just beating expectations, okay? And also Europe is investing a lot of money into defense, okay? And you have companies like Rheinmetall, see, German company, produces weapons, produces tanks, and this thing has been just shooting to the upside with a lot of momentum, with a lot of force, which is also bullish overall for the DAX. So that is why I like the DAX story. I think economic data is very bullish. I think Europe is spending a lot of money into their economy because of defense programs, and possibly you have some investors flocking from the US stock market into other assets. What do I mean by that? Well, the European stock market, possibly Bitcoin, possibly gold. Okay, so I see you guys really want to see gold. You love gold, so let's do gold. So for gold, my problem is I would like to be a buyer in this market, but my problem is that I believe we are still in a risk-on environment. So yes, last week on Friday we had the Israel and Iran drama, so that pushed gold higher a little bit. See, I think this was Friday. Yeah, it had a nice bullish day. But overall, I think we're still risk on in terms of the S&P 500. In terms of the US economy, I would say we are still risk on. I would say the tariffs are behind us. I would say the majority of the sell-off from the tariffs has been put behind us. See? And I think for gold, you would need some sort of a catalyst. You would need some sort of a reason for this thing to explode up. So you would need some sort of a crisis, some sort of a problem to arise, and then gold could be going higher, right? In that case, gold could go higher. If we do break this high, if we do break this area with momentum, I'll be looking for buy setups. And if I get a bullish reading on the edge finder, okay, if I just check the edge finder and I put in gold, let me quickly see what's up with that. Okay, it's getting a bullish reading. I can see COTS, commitment of traders, is bullish. So we're getting a bullish reading on gold, which is nice. So if we do break that high, I would be potentially looking for buy entries. So let's say we break it with momentum, pull back a bit, and then I can look for an entry on the 1 hour chart, something like this, pretty small, like a flag, break and retest, reversal, liquidity sweep, any sort of an simple entry pattern on the 1 hour chart. And then you could also see the 20 EMA kind of catch up a bit as well. I use the 20 EMA as sort of an indicator when the price is overextended. For example, here. Do you want to buy here? No, not really. Do you want to buy here on these highs? No, not really. We're kind of overextended. Do you want to buy here when we're kind of far away from the 20 EMA? No, not really. Much better to be a buyer here, 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 for example. See, anytime the price touches the 20 EMA, you're getting a much better entry. You're getting a much better risk to reward. For example, if I got in, let's say price moved higher. Let's say this happened. And let's say I got in like this with a stop loss below this structure. Now that's a very bad risk to reward. So you're getting a very bad risk to reward, but let's say you wait for the price to pull back a bit. Now you can get in lower. Look at what happens to the risk and reward. Okay, you're getting much more profit for much less risk. That's why I like getting in lower. That's why I don't like getting in straight on the tops. All right. So, and you guys can put it in the chat. So if you're bullish on gold, you can put in buy, and if you're bearish, you can put in sell. I'm interested to see kind of the sentiment in the chat. I personally am neutral to bullish. I'm neutral to bullish because we are stuck here in this range. We are kind of flat. I would like to see a breakout. I would like to see price breaking out of this range with momentum, and then I would be looking for buy setups. Okay. One thing I do like more, okay, Mark is bullish. One thing I do like more, and I actually have it on the watch list, is silver. Okay, so if you like gold, you're gonna like silver, because silver is very interesting right now. Silver is actually getting bullish price action. Okay, so I'll send a buy, Jakub buy, DJ is waiting / bullish, Marwan is neutral. Okay, so I think mostly bullish. Yeah, mostly bullish sentiment. Interesting. So I'm with you. I'm with you. I'm looking for buy setups, but I don't really want to buy in this range. I don't think it's the smartest decision to buy in this consolidation. We could very easily just range around. If you don't get a massive catalyst on gold, if you don't get a massive reason for gold to go up, this can happen very easily. You can get a very large consolidation. Gold is known for these long consolidation periods. See, here is one in 2020. See? So do you really want to be stuck in something like this? This lasted for how many days? Let's see. I mean, it lasted for almost 3 years, even more. Look at this consolidation. Yeah. Just 1,320 days until we finally broke out in 24. So consolidations on gold can last a really long time. This may be a start of one. Lighten says, just joined. Where is Nick? Nick is coming, I believe. I think he had some issues with his power at his house. I think he had a power outage, but I'm sure he's going to fix it, and I'm sure he will be here on the stream. The stream is going as planned. The A1 team has a lot of guests scheduled for today. They're going to cover the Fed meetings, so make sure you stay for the whole thing because everything is going as planned. And yeah, the Fed meeting should be pretty interesting, especially the press conference. And do watch the dot plot as well that I mentioned. So the dot plot is really important. You can find it on the Fed website. Okay, you can go to the macroeconomic projections, and you can see what they think about the interest rate. Maybe they will actually they will actually put in more cuts than expected. So just so you know, in 2025, 2 rate cuts are expected. Anything above that, if we get maybe 3 rate cuts or 4 rate cuts, or let's say bigger rate cuts, that should be bearish for the US dollar, and it should be bullish for the stock market. Okay. So I was talking about silver. I think a lot of you guys would benefit from actually watching silver, not gold. The reason is gold has been going up for months now. Gold had a massive uptrend. It gained a lot of value, like 65% in just, let's say, 467 days. So that's massive. Silver, on the other hand, hasn't been doing so great. It hasn't been doing so great. So still, yeah, it went up, but I think silver can do a lot better. I think silver can go up a lot more. Silver is actually not at the all-time highs. All-time highs are all the way to here. So you have a nice target if you want to look at it. You have a nice target at this level. And I think there's a high probability that we're going to reach this target. Usually silver does follow gold. It's kind of a similar scenario to Bitcoin and Ethereum or any other altcoin. Bitcoin goes first, and then the altcoins, the shitcoins, the Ethereums, they follow. So gold already did majority of its move. I'm not saying it can't go up more, because of course it can. Anything can happen in the markets. But I'm saying that silver is a great catch-up trade. Also, if you look at the daily chart, we just broke out of this massive range. We were ranging around for quite a while, quite a long time. And we just broke out with some very nice bullish momentum on the daily chart, right? Let me quickly glance at the Edge Finder. I think we're getting a very nice bullish reading as well. So for silver, yeah, we're getting a bullish reading. The commitment of traders is bullish. So that's nice. Institutional money is buying silver. Institutional money is buying gold as well. As far as we can see on the Edge Finder, I think that's a great confluence. Now, I'm looking for a bit of a pullback. I don't really want to buy straight here on the top. Okay, I don't really want to buy straight on the top. I would like to see the price pull back a little bit, to this level, maybe touch the 20 MA, and then I would be pretty happy to get in on a buy position. So a bit of a pullback and then some sort of an entry on the 1-hour chart. One chart that is interesting that you can take a look at is XAU USD, which is gold / XAG USD. So that is the ratio of gold to silver. Okay, gold to silver ratio. And you can see the equilibrium, the median, or let's say the middle of the range is kind of here. So usually when gold gains a lot of value but silver doesn't, we quickly rebound and silver follows up, right? You can see it happen here. Here, gold appreciates massively, then you get the balance. Gold goes up massively, then you get the balance. Gold goes up massively. We're starting to get this chart to balance out. Okay, this chart is starting to go down. I think it can go down even more, which is a bullish case. So that is a bullish case for silver. Okay. Yeah, I can see it in the chat that DJ says if DXY breaks lows, then we start buying in gold. That's something that is true. So you're looking at the dollar. You're looking at the DXY. You're looking at the strength of the US dollar. And if this chart continues breaking lower, as it has been doing for quite some time now, so if this chart does continue breaking lower, you can see gold going up. You can see pretty much any asset that is tied with the dollar go up. I'm talking about euro dollar. I'm talking about the pound. I'm talking about gold. I'm talking about Bitcoin. Okay. All of these charts could go up. So that would be another bullish case for gold. For example, if today the Fed comes out with future projections and says we're going to cut a lot, that's bearish for the dollar. And then if you have the press conference with Powell and Powell comes out and says, yeah, I like the inflation data, I don't like the jobs data, I think we need to cut interest rates a lot, then you could see the dollar sliding lower. You could see a big bearish reaction on the DXY, and you could see gold appreciate. In that case, you could see the gold chart go up. So I have my alert set. I'm prepared. I'm waiting for a breakout of this level, and then I would be pretty happy to look for some buy setups if the fundamentals are still bullish. Currently, they're looking okay. Another thing with the dollar, with the DXY, is we are at this sort of support level. We're definitely at this support level, and this is a key level to see if the price can break out, go lower, or if it will bounce, possibly range around a bit. So this is a key level for the DXY. To be honest, I would not be loading up on dollar sells. Okay, I would not be loading up on things like EU, GU. I did try to take a buy setup on GU. It didn't turn out well. I took a loss. Possibly even waiting it out. As I mentioned, I am waiting it out on gold. But I think this key level could produce a bit of a bounce. Okay, it could produce a bit of a bounce. So if you are short on the dollar, meaning long gold, meaning long, let's say Bitcoin, meaning long euro dollar, meaning long pound dollar, if you have a tight stop loss, you could get stopped out because we could get a bit of a reaction off of this key level of support. We could get some bullishness out of the DXY, especially if the Fed comes out hawkish, if Powell is concerned about inflation, if he is not sure about tariffs, if he is not sure whether to cut rates or hold them steady, if the dot plot comes out hawkish as well, if we don't see 2 rate cuts in 25, if we only maybe see 1, or maybe if we see 0 rate cuts, that can push the dollar up. If there is an escalation, even bigger escalation between Israel and Iran, that could push the dollar up as well, because the dollar acts as a safe haven. If there's a war, if there's a crisis, the dollar, in theory, should go up, right? So, and you can see on Friday, it started to push up. The DXY started to go to the upside. So Dragon says that he's long on GU. Yeah, I took a buy setup on GU. I mean, GU has had some really good fundamental data, some really, really good fundamental data. It kind of lost its bullish fundamental reading lately. We got some GDP numbers and some other economic data as well, which did not turn out the best. So I did take a buy setup on the 4th of June. It was a flag on the 1-hour chart. Okay. It was a flag, right? And unfortunately, I did get taken out on Friday, on Tuesday. On Tuesday, I think there was even a bigger escalation between Israel and Iran. And yeah, I got stopped out. It is what it is, part of the game. Also, as I mentioned, some bearish GBP data started to roll in as well, which pushed the price lower as well. So one more thing I want to do is oil. Okay. Now, oil is really interesting. We had a massive push to the upside. Again, we had a kind of a risk-off event, the Israel and Iran tensions. So that pushed the dollar up. That pushed gold up as well, because gold acts as a safe haven. And oil went up as well. I think Iran is a big player in the oil game. So again, concerns about oil production, some oil fields getting struck by missiles potentially. That's not good. So the price of oil has shot up from Friday. Yeah, just shot up like 13%. Yeah, and then retraced back. So massive uptrend on the US oil. I was looking for some potential buy setups. I'm not sure if I'm gonna continue looking at that. I was waiting for a breakout of this level, which we got, but then we exploded up. This price action is not really something I want to get into. I think it's a bit erratic for my taste, a bit too volatile. So for now, US oil is not on the watch list. Okay. So I can see also Bitcoin. So let's do Bitcoin. And I know you guys like gold, oil, and Bitcoin. I think I got that right. Bitcoin, I also took a buy trade, and GBP/JPY. Okay. Yeah, we can do GBP/JPY. Bitcoin, I took a buy setup. It was a break and retest on the 1 hour chart. See, we're trending up, broke higher, retraced slowly to this level, retested it. So I took a buy setup, and unfortunately, I did get taken out on Friday as the risk-off environment rolled in. I'm still bullish. I'm still bullish on Bitcoin. We're near the all-time highs. I think that the trend is still okay. I would say the uptrend is still intact. We are possibly also forming inverse head and shoulders pattern, left shoulder, head, right shoulder. Although I don't really trade these patterns, I can see them form. You could also make a case for a cup and a handle. All of these patterns are bullish patterns, right? But you would be waiting for a breakout of, let's say, this high before you're getting in. So I'm not taking those patterns into account. I was looking at fundamentals, which were heavily bullish on Bitcoin. You also had a risk-on environment, which is bullish on Bitcoin as well. So I took a nice buy setup. I also didn't want to get in when we were at the all-time highs. I was expecting a pullback. Then we pulled back, went up again. That was a bullish sign that the uptrend will possibly continue. So yeah, Bitcoin, I'm still bullish. Not currently looking for buy setups. Currently being a bit more patient. Okay. So yeah, currently being a bit more patient on Bitcoin. I have some other stuff on the watch list that I prefer. If Bitcoin does break out of this high, if it goes to all-time highs, I would be pretty happy. I would be interested to get in on buy setups, of course, if it is in line with the edge finder. So we had GBP/JPY. GBP/JPY. So let's see. Let me first type it into the edge finder. Where is my edge finder? See that? Edge finder. GBP/JPY. See, neutral. Okay, we're getting a neutral fundamental reading. As far as technicals go, well, we're pushing up on the daily. We are pushing up. We are following the 20 EMA. Overall, yes, you could say we're stuck in a range, but the daily chart, I would say it's trending up. 1 hour chart, it's very corrective. It's very corrective. To be honest, I'm not touching this currency pair. As I mentioned with my pound dollar trade, the pound had some very good fundamental data, and then it started losing. Its bullishness. Okay, so we also have the Bank of England interest rate decision, which is tomorrow. Okay, yeah, I'll definitely be paying close attention to that. So because the pound has been losing some fundamental data, and on the yen, I'm not really bearish. I'm sort of in the neutral camp for the Japanese yen. I'm sort of in the neutral camp, so I don't really see an advantage of buying or selling GBP/JPY because the pound has been going more neutral and the yen is already neutral. So I don't really see a reason for this thing to take a trade. The only thing I can tell you is, as far as technical analysis goes, I can see on the daily chart we are forming higher lows, right? We are definitely forming higher lows. So you could be bullish. You could be bullish. I personally think there are much better assets out there that I have here. NJ has been going great. DAX, pound dollar, no. I'll remove that now. Okay, I'll put it here below. But the NASDAQ, waiting for a pullback on the NASDAQ, and silver, I think is a great opportunity, silver. Okay. Andreas, what is up, Marco? Your thoughts on Euro Aussie? Sure. Let me do Euro Aussie. And I think that will be the last one from me today. I think you have Chris Pulver coming after me. So Euro Aussie, let me first check the fundamentals. Euro Aussie. Let's see that. Bullish. Okay, we're getting a bullish reading. And I mean, it looks interesting. It looks interesting. It's a nice bullish reading. It's not something that I'm closely watching, the Euro Aussie. We are getting some bullish momentum here as well. So 1 hour chart, kind of pulling back now. Yeah, I don't think the technicals on the daily chart are as good as, let's say, what you're getting, I don't know, NJ, which is following the 20 EMA nicely, or the DAX, which is also just grinding higher now. Okay, pulling back, but yeah. So for the Euro Aussie, I of course have a bullish bias because of fundamentals. Euro dollar is getting weak. Yeah, I think it's getting a bit weak along with the pound dollar. So Euro Aussie, fundamentally bullish. Technicals, I don't like them as much. Okay, I think I would need first to see this momentum continue up a bit, form some higher lows, some steady higher lows, have the 20 MA just look a bit better, look a bit more bullish, and then I would be looking for buy setups. So Euro Aussie for me is a pause for now because of technicals right here. And I think that's about it. So yeah, I think we now have the next guest coming in. So thank you guys very much for watching. Make sure to stay for the Fed meeting, for the press conference.
Hey, if you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, extra clips and bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream, or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
What's happening, everybody? Happy Wednesday. Calm before the storm, FOMC at 2 p.m. today. Looking forward to doing the trading battle here in the next 60 minutes with Nick hosting, Blake, Morrow, and myself. Currency strength in the day, we've got Aussie and New Zealand on top of the food chain, Japanese yen in third place, kind of closing in. Baseline is pound and euro, weaker currencies, Swiss, no problems there for me. Swiss National Bank has a rate decision tomorrow morning. They should be cutting to 0% per the economic calendar. That would be nice to see an additional move in the Swiss. So let's see if they in fact do cut rates to zero. Continuing to allow me to justify the positive swap trades that I'm in. Aussie Swiss long, CAD Swiss long, Euro Swiss long. I got it on my pound Swiss already. I got it on my dollar Swiss and I'm back in it. So I'm in, I think I'm in 5 of the 7. So Swiss yen, no trade. Pound Swiss, no trade. dollar Swiss, I'm back in with a lower break even than before. I took a big profit at the 9,200 mark. And anyway, let's talk shop. So I put on a trade yesterday right here. So basically, as long as the oil futures market stays greater than 50, I am going to grab about $2.20. So it'd be a $220 winner. Pretty high probability profit, around 86 to 90% chance of profit on this one. If we are going to see, elevated conflict or sustained conflict, we will likely deal with some higher oil prices. As Marco was saying, with the Fed today and Jerome Powell at 2:30, it's probably all going to be about the Fed and Powell's press conference more so than the actual 2 o'clock rate decision. Nothing is supposed to change. I mean, I was looking at it yesterday. The website wasn't popping up for me when I was doing my final hour session yesterday. But we have like a 99. Yeah, it's basically baked in that there's obviously nothing that the Fed is going to do today. Tomorrow's news today type thing. And even for the rest of the year, it might be a September, December only. Look, I think that Jerome Powell is probably way more focused with this current Fed with not letting inflation spike back up, get out of hand, and maintaining a pause. I know that they're getting a lot of criticism from Donald Trump. There are some macroeconomists out there saying the same thing, that the Fed's behind. Money supply is showing higher because of the front running that we had with the tariff situation and trade war. But there is some weakness. I mean, if we're watching the U.S. labor market, we are seeing jobless claims starting to tick up a little bit higher. Continued jobless claims are starting to show a bit more of a trend. I still think the resiliency is there. I still think this market is tilted higher. I think the bias is cautiously bullish, but I think cautiously bullish can go into like a irrational melt up, and that's probably more of the pain trade, in my opinion, in 2025 than a collapse. So it is attractive as it is, and as clickbaity as it is to get people scared about how bad this market can be. I mean, clearly, if you have traded anything in the last 6 months, the last 6 years, the last 10 years, the last 20 years, 30 years, this market has a way of showing a lot of resiliency. And on top of that, it can stay, certainly on the bullish side, way more bullish, way longer than it can stay bearish. And I think that the Trump administration is pivoting very hard where they don't want to see a down stock market. They are going to try their best to do a growth plan. So instead of the K-shaped recovery that we saw with Biden, which is, the markets have actually outperformed so Biden's administration, just here, like generally speaking, him serving as president as just like a puppet for presidency. That administration was very much favored towards if you have assets, you are getting assets to appreciate very, very aggressively. And I think that was, supposed to be seen as an administration that was very asset friendly, good for the 1%ers, good for those that have investments, good for those that have assets. But yeah, I think everyone can agree that since 2020, things have been more expensive. Life is more expensive. Insurance premiums are way higher. The cost of living is higher, and none of this is really changing. So Trump's coming in campaign promises in 2024 to say that we're going to fix this, right? We're either going to let Wall Street take a correction, let Main Street get fixed. But the reality is it's more of this dynamic. I think what's happening is Trump is trying to promise this. We're going to grow from the bottom and grow from the top. And so we go from a K-shaped to now maybe an E-shaped, where things get a little bit better. I don't think we're there. I think we're a long ways from it. And in fact, I still think that this is going to benefit the top way more than the bottom. Okay. So point is, I think the pain trade is more of a global melt up. The reason why I say that, and I've been talking about this a lot in 2025, is because after the pivot on April 9th, we still see a lot of flows going back into Europe, which has a much lower price to earnings than the US. We see a lot of money repatriating back into China, as since last fall, China's been ventilating the risk and trying to prop up the property markets and the capital markets. We see emerging markets doing better. We see individual country ETFs that are non-US doing better. The MSCI ex-US is doing better. We see a lot of countries that are double-digit gains in 2025, and the U.S. is still not. Year to date, what are we doing in the U.S.? Let's go to the sector performance. For the year to date, we have the S&P up 1.72%. So, is it possible that the S&P still gets to 10% for the year? Maybe. that would be a very good run considering we've had two 20+% years. 2023 was over 20%. 2024 was over 20%. 2025, we're sitting here plus 1.72 after dealing with a 20% peak trough correction. I think realistically, if you go from like year to date, I think we had about a 14 or 15% correction in the S&P from the year to date performance, but we did get to all-time highs and then we did drop. So anyway, taking on that much risk to make 1% in the S&P doesn't get too many traders excited. But I do think that at the end of the day, as long as you're not losing money and the market still, ekes out a bit of a gain, is still good. This year, I think that as long as the U.S. remains stable, it's fine, right? Like the U.S. might be a trader's market while the world is invest in something that's cheap, go value driven. All these, long-time value traders that have been just watching lackluster performance for many, many years. Look, if you trade tech in the US, you've done pretty well the last decade, for the most part. Obviously, you've had some pullbacks and drawdowns. You've had some sideways chop. You've had some nasty moves the last 7 or 8 years with 20+% corrections like 7 times in the last decade. But it still shows reflexivity and resiliency of getting back to all-time highs. So anyway, I still think this entire sector dynamic is really interesting in 2025 because of what's leading. These are not typically sectors that are leading a bull market. These are sectors that are at the 7th inning of a bull market, 8th inning of a bull market, and eventually we rotate into most likely earnings changing and getting compressed lower. So I don't know how we can continue to grow from a 22 times earnings the S&P without having at least like lackluster returns. Maybe it's steady growth rather than compressing growth. But this is why inflation is so important. This is why I think the Fed is going to be focused way more on inflation and not letting it rear back up, as opposed to, playing the game of running this economy hot, just melting up the market into most likely another asset bubble. I don't think anybody be shocked. I certainly wouldn't be if we go S&P. Let me use this workspace that I have. That's just blank. I just use it so it's really clean. So this blank workspace, I usually like to look at this on a monthly time frame. So here is the S&P. So let's go SPX. Okay, so I don't know if we're going to get to 6,400 in 2025. If we do, it wouldn't be awful. I mean, we started the year off. Here is the February candle. I mean, we started off right here. Here's January. So if we get to this Fibonacci extension here around 6,400, this is January's start to the year. And that, oops, I'm trying to go measurement here. So if we start at January's open and we get up to that level, I mean, that's almost perfectly in line with the averages of the S&P return at about 8 to 9% for the year, dealing with like a 15% correction, which is pretty much what we had. So it's kind of interesting. It's just funny to me. Like we could have an 18% correction. We can still finish the year, 8 to 9% positive, and you still have happy investors. Despite what happened, you still have happy investors. Now, I obviously hope to outperform that. If we're going to go up to 6,400 in 2025 as an end of year move, fine. I mean, I just want to make a lot more than 9%. I think coming out of this drawdown and coming out with 20+% gains feels pretty good. If we go another 8 to 9% higher from here, or I guess because we'd be slightly higher than the January open. If we go from current price up to 64, that's another about 7% to the upside. And there's no reason for it to necessarily just halt at 6,400. We might still have this melt up into 65 and change, but let's take this trend line. Okay, let's use some technical analysis here, do something really simple, and just make a parallel channel. Okay, so if we have a sharp bottom like we had in April, and this market finds a way, even if we deal with some chop here through the summer, things slow down, things get a little iffy, volumes dries up a little bit, liquidity dries up a little bit. It's just quiet. Like I mean, seasonality wise, things slow down in the summer. Okay, but if we do continue this melt up, I mean, I think a technical channel would make some sense here. We could hit 64, 65. One thing I'd be watching, this is a little bit lagging, but I built this workspace out here. Go back to the SPX. Okay, this is an indicator that I watch pretty closely with a buy and sell zone. It's pretty laggy, so I don't. This isn't how I time the market. But when we turn, this is a really good indicator for broader based strength or weakness. So when we turn here with some sustained bearishness, I mean, that turn, interestingly enough, was right here near the top. Okay. When we started to see this turn over here, it obviously wasn't the bottom. Okay. But this is where the strength started to come back in around that 5,600 level. Right after that, you can see that, okay, we cross a key zero line. We get a nice pop. That was during that US-China trade agreement gap, which pushes the market up another 6 or 7%. So obviously, it kind of helps either one avoid the downturn, which is obviously a lot of pain from 15 to 20% corrections, but also once we have confirmation to position accordingly and start to participate in whatever this upside is. Now, I still think the upside is limited to maybe testing all-time highs and then maybe fading. I think you go into any charts, you'll see that there's clearly a lot of divergence. And I've mentioned this, multiple times now, but if we go into, I've got a pivots harmonic workspace that I use for my divergence levels. I use a zigzag on price action, which is looking for big turning points. I also use, let's go to, mags is fine. But mags is a lot like the S&P, which is a lot like the NASDAQ, which is a lot like the Dow and the Russell. The US index is showing some signs of divergence. So mags has been making slightly higher highs in price, disagreement in momentum, slightly higher highs in price, disagreement in relative strength. That to me is hidden bearish divergence. Make sense? Hidden bearish divergence. So I'm not saying that's a guarantee the market's going to fall, but it would make some sense to me that look at all these demand levels. This is just mags, but you can use this on S&P. I'll go to that chart in a moment. Okay, look at these demand levels. It's nothing but demand levels. So I don't see any supply zone up here. I see that the market would hopefully allow some buyers to come in anywhere in here and find some pretty nice support. There's support around, this is mags, but we'll go S&P here in a moment. But if we find support at this, right where the market gapped up on the US-China trade agreement, right in there, coming back to find and fill that gap on the US-China trade agreement, heck, just break the trend line. If we break the trend line and we come back and retest the backside of the trend line, that's okay. Just give us something here to position for, maybe a run back to highs. The trickiest trade, in my opinion, in 2025 right now is after navigating this and coming out on the right side of it. The trickiest trade would be having this market go up and up and up and hit all-time highs and not really pull back. That to me would be the most frustrating trade of 2025, because all it's forcing me to do is stay out of the way. I'm doing a lot of like safe, wide margin for error income trades, and it's fine. It's still generating income. It's still moving the needle. I'm still outpacing the benchmark, but it's frustrating to not be able to position with a little bit more, I would say, aggressiveness. If I'm confident we're going higher, I want to position for that. I'm just not confident that this thing goes higher without having some type of dip or pullback. So I hope we get a pullback. I've said that now for the last couple months, but I'm not bearish. I did put on a couple inexpensive hedges. If anybody's interested, I threw in a trade on the SPY and the Qs. I'm basically doing like an out of the money bear put spread, which is right down here. It's way out of the money. It only cost me about $500, but it could potentially pay me about $8,000. So it's a low cost hedge, and I don't need price to go all the way down here to make money in the trade. All I need price to do is basically find a demand zone, and that $500 is probably worth maybe $500, maybe $1,000, maybe $1,500, because I have 15 to 1 or 20 to 1 upside. I could easily turn that into a 2 to 1 or 3 to 1. And if that's enough, I would take, let's say $1,000 profit on 15 accounts, make 15 grand in hedges, help me weather the storm, help me alleviate some of the drawdowns, and then I can reposition for a move that's going to get us back into all-time highs. And then when we break these highs, maybe there's where the momentum is to get us up to 6,400, up to 6,500. That makes sense? So again, go to the charts, higher highs in price, and disagreement with momentum, higher highs in price, disagreement with relative strength. To me, that is hidden bearish divergence. That's on the SPY. That's on the Qs. Same thing. So I just don't see this market without having like a squeeze to the upside to poke those highs. I don't see this market really sustaining a bull run. I think we have to have at least a technical correction first. And I do think there's big money to buy. I think there's big money to buy support. I think that any type of dip, maybe it's enough to rattle out the retail trader. Arguably the retail trader is the only crowd that stayed in this market and bought through the dips, while institutions just kind of held. They didn't necessarily sell. They didn't panic sell. They just held. So they just haven't participated necessarily in the upside. But if the S&P is up, about 2% year to date, I mean, mutual funds, they're probably okay. They're probably break even. They're maybe if they're lucky or worth anything, they probably are at least ahead a little bit. When the market's had a 20+% melt up, there's a lot of ways to participate. But anyway, we never know. So I think the trickiest trade is going to be we keep going higher and we don't pull back. That's going to be the trickiest trade. I think what would be a great trade would be we either poke the highs and then fade back down, or we roll over. And I'm going to zoom in on this chart right here because I've been watching this the last couple of weeks. We're just hanging out right around the right side of this trend line. Okay. And I don't know with today's price action, it's Fed day. It could be noisy. The market, does it take out a low or take out a high? I mean, we have a holiday tomorrow, so there's no US markets open. But when we come out and finish the week on Friday, are we below this low, which I think is a critical support level, or are we above the highs? Okay. I mean, my thoughts on Jerome Powell's press conference, obviously it'll unfold here at 2:30 to 3 o'clock. He might take questions even later than that, but it's probably going to be pretty scripted. It'll be likely the same statement with whatever commentary comes in with the FOMC on the pause. It'll be very similar to what we had the last couple of months. It'll be his press conference, what he acknowledges, what about inflation, what about jobs, what about stability, what about their mandates, what about whatever, all that stuff. That's what he does. He's very good at talking like right down the middle. I mean, we could do this, but we might do this. It's like either or. It's a lot of either or, and price action reflects that. We typically see a lot of noise during FOMC day, okay, and we're sitting right in the middle. So, is it possible that prices today do this and finish in the middle? It's very possible. Is it possible that we actually start to roll over? Maybe Powell acknowledges that inflation is a big uncertainty and they're worried about it, and they're starting to see softness in the labor market, but they're not willing to cut yet. I don't know. So it's like it's not my job to speculate. I mean, I just want to be aware of price action and how it plays out. I think that if the market takes out this low right here, if it takes out the low, there's just room to fall. It's that simple. And all it's going to do is fall into open arms. I think the market gets caught by a lot of support. I think there's good structure in the market between 5,900, 5,800, 5,700, lots of levels to be looking to buy back into. But a clean little correction down 3, 4, 5%, down 4, 6, 7%. Is actually a very good opportunity to reposition for equities. I don't necessarily want to be crazy short. I just want to have that big asymmetry protection in case the market is going to take a nasty spill. What else could, I mean, again, this market shrugged off so many bad things, but what else could kind of snowball this into something worse? Well, I do think we've talked about this blind spot of the Japanese yen. The Japanese yen, the Bank of Japan kind of pivoted harder. Where if you look at, trying to think, what is it, JP 10? The 10-year, let's go JP 10-year and JP 30-year. Actually, let me switch this chart back up. So JP 10-year. So JP 10-year was up to around, this is the bond yields. Okay, so we've got the 10-year up to about 1.6%. We've got the JP 30-year, which is up. I mean, this is a pretty big spike, and this wasn't that long ago. This was a move at the end of May. You can see this pivoted pretty hard off of a 3.2% yield. So is the Bank of Japan quickly pivoting into they want to see lower yields? Maybe they want to see a rise in bond prices as opposed to a rise in yields, and this might help bring down the U.S. 10-year and 20-year yields as well, right? That's been the one sticky part is if we continue to see rising yields, then it's going to be difficult for us to grow our way out of this stuff, right? I mean, I think for us to grow, we have to have yields down to probably 4% or sub 4%. Problem is how we got to sub 4% was not a good equities market. We were able to see sub 4% literally in the market was at one of its most painful points. So I don't think that sub 4% comes with anything good in equities. I also think that staying sideways. I think that staying sideways here from 4.3 to 4.6, 4.3 to 4.6, 4.1 to 4.6, I don't think that's going to be helpful either. I think this is just going to put this big overarching burden on, can the Fed actually cut rates? If they cut rates, does the bond yield market react differently like they did last year when they cut rates by 100 basis points and this market was up literally all of it? Okay, this market jumped up 120 basis points as the Fed cut 100. That's not the correlation that typically plays out. So this is the bond market showing, hey, look, if you want to keep cutting rates to zero and inflation's not going away, the yield market's going to tell us something different. Global yields rising is going to tell us something different. So, I mean, I personally don't like to have a lot of bond exposure, but the bond market is a very intelligent, sophisticated market that will correct the market. Case in point, you saw the UK do it back in 2023. We saw the US market do it this year with this basis trade. This trade right here from this low to high, this is what forced Trump, Bessent, the whole administration to pivot very hard. This is the first administration in a long time that actually had support from voters from both sides of the aisle to start cutting government spending. But to do that, we started to basically break the market. And that pain was making the financial markets flex. And that was enough to say, we're not going to do that anymore. Let's go growth mode. And now the focus is growth. Okay. Problem is we're talking about growth while the Fed's not cutting rates. It's not accommodative. The government still wants to spend. I read something this morning that was kind of comical. Let me see if I can find it here. Let's see here. New Fed chair odds flip. Christopher Waller now new front runner. How are you finding this stuff? I don't know if anybody's tracking like who's going to be new Fed chair next year. I would imagine. I mean, Scott Bessent is Secretary of Treasury. Christopher Waller is probably going to go right in line with what Trump wants to see. Again, I'm obviously not going to be the Fed chair. It's not my job. But I will say that if Powell craters to pressure to start cutting rates and the bond market reacts adversely, I don't think we're going into anything good other than a melt up. I think a melt up is very beneficial and very profitable. The problem is it runs up and it melts up into a bubble, and that bubble will burst, and we'll have another 20+% correction, and we'll have another 20, maybe 30, 40% correction. And if you're not positioned for that or prepared for that, it's just like this all over again. If you were not prepared for that correction from February into April, and your account was beat up so badly, you've got to think about different ways to survive these markets. I mean, I'm very much like risk first, like manage risk. Upside is easy. So I mean, I'm always looking at risk. And it sucks because it'd be nice to be like, look, I'm all in, I'm all invested. I'm just enjoying this melt up tick for tick and making more money and generating alpha. It's difficult. So anyway, I don't know if we're going to get a Fed chair in 2026. It's going to be more of like a melt up pawn where it's like we cut rates 1 to 200 basis points and the market runs hot. And we're sitting here at 6,500 S&P, 7,000 S&P. Look what we did. We just made all-time highs. We crushed this market. Everyone's winning. And then the market dumps 30-40% because their S&P earnings are up to 26, 27, which is historically high. Ultimately, that's going to mean bad things. So but that's the famous saying: the markets can remain irrational longer than traders can remain solvent. I'm not trying to call the top. I just hope we have some technical obedience to see the market pull back, offer some dips, offer some demand levels to buy, position accordingly, see some all-time highs with some melt up, and off we go. Right? I mean, if I could position for a confident directional stake of 10%, if I can see the market pull back into this like 58 to 5,700 zone, and I can position for that to get back to these highs, there's a lot of money that can be made there. I mean, it takes like a couple of staggered positions, but if I go staggered out here for maybe, 3, 4, 5, 6 months of trading and holding, trade some options that are all risk defined, I could turn like 0.25% on 5 or 6 trades into the same. Like I'll take 0.25% risk to make 0.25% or more. And I mean, that's an easy way to kind of pad in where if this market goes up, let's say from, 57 and change back up to the highs, that's 7%. Could I turn a net 7%? Probably. Could I turn, more? Could I turn 10, 15%? Probably. Could I hold this with the tilt going towards this measure move at 6,500, 6,450? Probably. Right. So I think a good trade, like a gift from the market this year, would be a pullback. I think the harder part is if we hit highs, we then have a correction, and then you're wondering like, well, how bad is this? Do we just take out the lows? Are we back? This is a really big equilibrium. The market went down 20%. It's up 20+%. You can see how important this level is going to be. The bears kind of take control here. The bulls maintain control here. If it's in the middle, it's just hoping that things don't get worse. Right. So, and maybe it's not that difficult. Maybe the market just goes up, pulls back exactly like I want, finds support. And then we're talking through 2026 where things are better. We're at all-time highs and off we go for another good run. But as we watch this market day to day, just grind and grind and grind, I just think we show signs of like a rising wedge. We show signs of exhaustion. We show that it's long in the tooth. We show that there's overbought conditions with divergence. All these things typically mean some type of shakeout. And I think shakeout is a little bit better served to the downside, just so we can offer up a chance to get a correction, find some support, and then position accordingly, which is what I'm hopeful for. Okay. All right. Will gold fall if they cut rates? Not necessarily. I think gold and silver are great to have in the portfolio this year. I think they're trading like strong assets. I mean, one thing to give gold a lot of credit, it's been a long time traded asset. But it's behaving a lot like if you are questioning the dollar, if you're questioning the fiat system, gold's a good hedge, right? If you're questioning the ability to really curb inflation, gold is a good hedge. We've actually seen, and it happened this year. It's the case right now. It could flip. It could flip. But gold for a 20-year run, if you take GLD compared to the SPY, GLD has actually now outperformed the S&P over a 20-year stretch. Wasn't always that case, but because gold's been up this year compared to the S&P being flat, that's a big difference. So, like I said, it's going to be a correlation that changes, but gold is a good asset to have in the portfolio. I don't mind. I mean, even one of the simplest portfolios I could run, if I did basically a SPY Q blend for my equity side, and I do a gold, silver, Bitcoin blend with my non-dollar / precious metal combo, maybe AI, maybe asymmetry type speculation trades. That's it. That's it. Like SPY Q equity blend, gold, silver, Bitcoin. I don't need treasuries. I don't want treasuries. To me, lowering my volatility in my portfolio, I do that with hedges. I protect the downside in options, so I don't have to necessarily hold 40% in a garbage market like bonds that don't do anything. They've been in a 5-year drawdown. Bonds have not performed for anybody in the last 4 years. They've lowered volatility because you have, I mean, could you imagine allocating 40% of your portfolio to bonds that are in a 5-year drawdown? I'd feel like an idiot just hanging onto something that's going down. So anyway, I think gold's better. Gold, silver, Bitcoin, that's an easy mix. Okay. Let's see here. Quantum stuff. No, because at the end of the day, I mean, look, if I lose 15% of my portfolio to Bitcoin going to zero, that's what has to happen. Number one, is Bitcoin going to zero? I don't know. I mean, if Bitcoin goes to zero at this point with the last 1 or 2 years of adoption and mass adoption, I mean, look, it's a $2 trillion market cap. I mean, think about this. What's our largest market cap in the world right now? So Bitcoin is number 5. I've got fudge. I don't have it. Microsoft, Nvidia, Apple. What's my next biggest company? Microsoft, Nvidia, Apple. What's 4? Because 5 is Bitcoin. It's not Tesla. Okay. Bitcoin's a $2.1 trillion market cap now. So the consequences of having that type of market cap go to zero, I mean, I don't know. Quantum computing it's out there as a threat, but the whole point of Bitcoin is so it's not hacked. And it's also it's probably Google. Yeah, you're right. Probably Google. Anyway, but it's number 5. It's number 5. So if you talk about Mag 7, you actually have to give Bitcoin the credit that it deserves because this is a true $2 trillion market cap. And because BlackRock's in the ring, which has trillions of dollars under management, I think you can't ignore it. You can't ignore it. And like I said, to me, and I've said this from day one, 2016 is when I started dabbling in Bitcoin. 2017, 18, I got a lot more serious about it. 2020 onwards, a lot more serious about it. Now, it's part of my client portfolio. It's part of my personal portfolio. I think it's a very important part of my mix in order to potentially have a scary but realistic hedge against the fiat system. Meaning that if the government prints to oblivion, if our debt to GDP ratio climbs above 120%, I mean, this is what Ray Dalio's been basically soapboxing for the last 2-3 years with his book, The Changing World Order, right? The U.S. is going to lose its status, and things are going to change. The power struggles, and it's all these conflicts. Look, I'm not saying Bitcoin is the only solution. It's certainly not. It's tied to risk assets. It's tied to money supply. But now that it's been securitized and massively adopted, I think that it can stand on its own 2 feet. I think there's a lot more at stake in risk than there was if it was just a speculation thing where people are just buying and selling crap on the dark web. So anyway, that quantum computer stuff is because completely out of my element. I mean, does it? I mean, that'd be like saying, like, does AI, take 90% of the workforce in the next 5 or 10 years? Maybe it does, but that's a whole can of worms of how we handle it. So we will see. I mean, that's what's like terrifying and exciting about moving forward in 2025 is there's just a big question mark of where things are going to go. I'm trying to keep it simple. I'm trying to make some income. Nick, what's up, man?
What's up, Chris? I'm excited for our battle here pretty soon.
Me too. It's going to be a lot of fun.
Yeah, I'm here to kick you off so you can go join, get ready for Trading Battle, and then I'm going to join you guys in just a little bit here once that gets started. I enjoyed listening to your market outlook, and I'm excited in just a little bit to hear more from you in terms of the Trading Battle stuff.
Sounds good, man. Let's do it. See you in a little bit.
All right, man. See you soon.
All right. Thanks.
All right, guys. I'm going to just share my screen here as well. So we'll let Chris on out of here, and then we are good to go. Okay, so of course, in the next hour and a half, we are expecting some pretty big volatility in markets. Now, when I say expecting volatility, what I mean by that is that the market itself is gearing up for some moves. We can see it in the options market. We can see, when it comes to markets before this, we've been in consolidation, waiting for this. And today we're doing something different than usual. Today we're actually going to be doing a live trading battle between Chris Pulver and Blake Morrow, which is going to be happening in 25 minutes from now. I'm going to be hosting their battle, which I am so excited for. It is going to be such a fun time. In the meantime, I'm going to share some ideas with you guys here on what I am watching for here as we count down to this event. So again, we have the Fed in a situation, right? The Fed is in the situation where it's the risk is, ready, stagflation, right? This is the risk to the Fed. And the question is, what is Powell going to focus on more? Is he going to focus more on the risk of the stag or the risk of the inflation? Now, of course, this word, if you're unfamiliar with it, is the idea of having slowing growth with rising inflation, which is the worst case scenario for the Federal Reserve. If you know your fundamentals, then you understand this pretty well. But if you're newer to the macro and understanding why this might be so bad, let's just talk about that for a second. If you have an economy that is slowing down and the jobs numbers are really hurting and people are, they're losing their income, they're losing their job, right? And everybody's kind of holding back from making big purchases and everything sort of slows in the economy. That's not good. But the Federal Reserve in that circumstance can pull some levers to try and save the day. Specifically, what they can do, guys, is they can cut interest rates to make it so that people can borrow money at cheaper rates. Now, if you make money easier to borrow, guess what? Most people will go out, people who have been waiting for cheaper money, cheaper borrowing rates, they'll go out and buy a house. They'll go buy a car. They'll go buy things. They'll do a vacation. A business will take out a bigger loan and make hiring more accessible, right? Cutting rates helps to stimulate the situation or the economy, right? But the worst case scenario for the Fed is when you have a slowing economy like we just discussed, but you also have rising inflation. Because rising inflation says you can't cut rates into rising inflation. Because if you have already rising inflation and then you juke the economy full of stimulus so that people go out and spend money, inflation could skyrocket out of control and send us into a Great Depression level problem. So this is the scenario that many people right now, the on-edgeness of the market right now, is wondering which one of these two things is Powell and team going to focus on first and most. And I'll tell you the baseline for today. Ready? Here's the baseline for the scenario that we're likely to hear from Powell. Most likely, they're going to say, we're going to watch each of these equally. And we're going to say, if there's a problem in the stag or the growth, right? If growth, jobs data, PMIs, all those things materially worsen, then we're going to look to cut interest rates. But we're also going to watch inflation. And if inflation starts to get out of control, we're not going to cut interest rates. Basically, the stance of the Fed is expected to be they're going to act on whatever breaks first. which is, again, a little bit scary to think about, right? They're kind of like, okay, the jobs market's okay right now. Inflation is cooling, which is good, but we have tariffs to worry about. We have all these uncertainties, geopolitical events. So right now, the expected next move from the Fed today is to do nothing. And in fact, to guide that they're going to continue to do nothing. That's the expectation. But here is the thing that could move markets really big today. You want to talk about a surprise move one way or the other? If there is some favoritism towards one of these two. Now, when I say that, when I say favoritism, what I mean is that if the Fed says, if they leak, and I mean Powell, right? So if during the press conference, Powell hints that the stag component, the jobs part of this word, is more scary to them, if that is perceived, the market is going to rally because that will be a perceived Fed put. It will say, hey, the Fed's going to save the day. They're watching labor really close and we're likely to get some rate cuts. So that would cause markets, the stock market, to probably move higher and cause the dollar to move lower. Rate cuts are bearish for the dollar. They're bullish for stocks. Now, what about the opposite scenario? What if they come out, what if Powell says, hey, you know what? We are way more worried about inflation. Or if they lean heavy on the inflation side of this, that is going to do the opposite. Stocks would dislike that. They'd say, oh, we're not getting those rate cuts. And at the same time, they'd say, buy the dollar because the dollar is less likely to experience downward pressure due to rate cuts. Don't think your mic is connected. Oh, let me just check. Guys, if the audio is bad, I'm sorry. This is, I'll fix it here. Oh, yes. Hold on. I'm going to fix it. 1 second here. Sorry if does my mic sound better now? Do me a favor, guys. If you could, just let me know. Type yes in the chat if it sounds better. Just let me know. Better. Cool. Sorry about that. Yep. I'm at the home desktop setup and sometimes something gets unplugged. Actually, I had a power outage this morning, so my stuff probably just needed to get rewired a little bit. So going into this event, guys, sorry for the bad audio. So going into this FOMC event, couple things. First of all, we have something really cool that we're doing today. So if you're just tuning in, I just want to tell you ahead of time, we are going to actually be discontinuing. We're going to stop this stream at the 1:30 mark, and we're all going to switch over to watch the trading battle together because I'll be hosting Chris Pulver, which you just listened to if you were here for a few minutes. Chris Pulver is going to be going 1v1 with Blake Mara. So they're doing a one-on-one trading battle, and I'm hosting it. So I'm the mediator, and I'm so pumped for this because we're going to be trading FOMC. We're going to be talking about market-moving events or market-moving stuff, and it's going to be really fun. So if you'd like to just make sure you reserve your spot there, not that there's a limited spot, but more so if you just want to make sure you're there on time. So this is where it will be hosted, and we'll be jumping over in 20 minutes to that stream all together so that we can jump into the battle with them. It's going to be so much fun. Those are always a blast. So my bias, right? I'll share with you my concept. So Russell looks good. I'm still long the Russell. This is a position that I've been in for a couple, maybe 2 weeks now, 2 or 3 weeks actually. Been kind of a back and forth move here, but I do still like the Russell's upside. I think that the weaker dollar also helps the Russell out, right? The idea of rate cuts, basically. I'm also long the DAX, which has been not really moving too much just yet. I do still like the upside for the DAX. I heard Marco talking about this earlier. I've also got a bullish outlook on most of the major indices, but I am looking specifically for deeper pullbacks before I can get involved in any further long positions. So if we get something that's a little bit hawkish today from Powell and that sends markets lower, that may actually give me an opportunity to get long the indices as I like the overall setup. Taking a look at the dollar index for a second. So trend is still to the downside, right? When we take a look at the macro here, when we take a look at the macro and we just look at, hold on, I'm pulling up economic heat map, right? So let's get an idea of what the Fed might be looking at. And it's concerning in some ways. What I mean by that, services PMIs missed. Manufacturing PMIs missed. Both of those are bearish for the US dollar, right? At the same time, you had retail sales yesterday. Big miss on retail sales yesterday. It's another bearish tick for for the dollar. We also had some mortgage applications, which were down, right? So you had that become a bearish catalyst here for the US dollar. CPI here was also bearish for the US dollar. We had a soft CPI print. By the way, that's 4 in a row. 4 in a row weak CPI prints for the dollar. And that's good for stocks, but not necessarily good for the dollar, right? It's actually negative for the dollar. The rest of inflation is kind of so-so mixed. And then we get into some of the other stuff here. We take a look at ADP numbers were pretty rough. You had a jobs report that technically beat estimates, but not by much. It was a narrow beat. So my bias on the US dollar is pretty bearish at this time. We have a lot of stuff here still suggesting more downside in the short term to medium term on the US dollar. But you might say, well, Nick, the dollar's already trended lower here, right? It's already been a pretty, big downtrend. Clearly, it can't keep going like this, right? That's the famous last words for the currency traders out there, right? The dollar index could totally make a bigger push lower, right? In fact, I think that is the likely scenario. If you ask me, is it more likely for the dollar to make a move back to 102 or to make a move down to like 96, I would say probably 96 makes more sense. The Fed is likely to cut interest rates overall this year. We do see some economic data, as I just got done showing you, suggesting some more weakness for the US dollar, things missing expectations here recently. The economy seems to be showing some signs of cooling off, and that means rate cuts. So as we look at rate cuts, as we look at that prospect of more rate cuts coming, right? The scenario here becomes, okay, if rate cuts in the second half of this year are kind of the base case that I have, then I can't really justify getting super bullish on the US dollar. So for me personally, I'm not short at this moment on the US dollar heavily, but if we were to get a retracement or a break and retest of this area, these would be, in my view, opportunities to actually get short the US dollar. And I'll show you, based on our top setups page here, some of the currency pairs that I like better than others. A really obvious one right now, a really easy one is, and I say easy not as it's a certain that's going to go up, but it makes sense with my plan right now, is the euro dollar on the long side. The Kiwi dollar also, but the really obvious one is going to be the euro against the dollar to the upside. So if I pull up euro dollar, you can see it's had a nice breakaway move here in the last few months. Really nice push. Now, I am looking at a pullback here. I'm pretty close to potential entry around 1.14. Maybe we get that in the next few hours, right? So I'm keeping an eye on this. I do think that we have more upside to go in the euro. I don't think that this move is over. It's been a really nice run, and congrats to anybody who's been on the dollar bearish side. So we'll continue to see or I'll continue to watch to see if we can get a pullback entry on the euro dollar. So I do have that bias to the long side. I'm also still bullish on indices, as I just got done discussing, but sticking mostly with the bullishness on the bearishness on the US dollar. We also have some bullish readings due to those weak economic prints that's keeping us bullish on gold at this time. So if I pull up gold and I just say, hey, where am I at with gold? Let's talk about gold, right? So gold is sitting just shy of an all-time trading high. So I don't want to chase this thing, but I'd look for one of two scenarios. Either a dip back into this 3,300 along this trend line to the upside. I like this quite a bit. The alternative would be a breakout to the upside and a pullback into this structure of resistance. So to me, gold is a pretty clear on my system, my strategy, pretty clear bullish setup. So I like the prospect of more upside for gold on a weaker dollar. I like the idea of Russell moving higher on a weaker dollar. I like the idea of indices, rate cuts being around the corner is a scenario in which case I quite like the setup for, for gold right now. So we'll see if we can get a pullback. I would have to have one, a break or a pullback. A break and retest or a retest here of the support would be something I need to see in order to place a trade myself, but I'm watching this pretty close. It's raining pretty heavily outside of my house. I'm just seeing that. Let's see what else. So like I said, Russell's up 1% today. It's been back and forth here. I'm still in this trade. Have some currency trades active right now. I just want to remind everybody, and again, we will drop links here in the chat for everybody. In the next few minutes, we are going to be actually transitioning the stream over to our very first Well, I guess we're revamping. It's the recreation of the trading battle. And I'll show you what this looks like really quick. So starting in just a few minutes, we've got the trading battle happening between Chris Pulver, who is just on the stream, and Blake Morrow. And I am super excited to host this. It's going to be happening in the next few minutes. So let me just actually drop this one more time. So I'm going to be hosting their battle. This is where it's going to be at. Do not miss it. It's going to start in 10 minutes. I'm going to be jumping off of this stream in just a few to participate, to jump into there. So make sure to join me there if you have not already grabbed that link. We're going to be doing the stream there. And basically, we're going to be live trading with those guys FOMC today, which I'm pumped for. So what else? Any last thoughts before I get ready to transition there? We got the Nikkei up 1% today. Hong Kong 50 down 1% today. Did you guys see silver? Silver has been a monster here recently. Just a really strong push. By the way, if you're interested in getting access to the Edge Finder or to our VIP membership, let me just not forget to do this really quick. So if you are looking to get access to the Edge Finder or to the Gold VIP membership, we're currently doing a 45% off discount during this live stream. So if you are interested in getting access to the tools that I use to scan the markets, or if you'd like to get access to our signals, everything is currently 45% off. Here's how you can get it. Click the link that just got dropped here in the live stream chat. Let us know that you're watching the stream, would like to get access, and you can get it there. But yeah, you can pick up a copy of the Edge Finder if you're interested. The stock box, the VIP membership, whatever you're interested in, we're doing 45% off right now in celebration here of this big day, this FOMC day. I like these days a lot. A lot of people really are afraid of news events. I actually love news events in general because that's what builds biases, right? The catalysts come from big news events. Now, if you're gambling, if you're like all in on a gold short into an NFP report, yeah, you might not love news events because you've probably been burned pretty bad. But if you're someone who's like, you know what, I'm a fundamentalist. I like understanding the jobs report or understanding what the Fed is thinking. We love that stuff here. Like, that's the thing that's kind of crazy is a lot of traders, they hate news. They're afraid of news. They just call them those red folder days. I don't trade those, right? But fundamentalists recognize that the market moves based on economic data, based on news, based on fundamental analysis. That's what moves the market. So if you're really going to be a trader that focuses on that stuff, those sorts of days should be exciting, right? Because it's like, okay, we are getting some information. This is going to help build a bias. In fact, I find it to be the most annoying when it's not a big day or big week in the markets, because then I feel like we lack that catalyst, that potential market mover that can really get things going. So yeah, we will, would rate cuts drop gold and silver? Most likely rate cuts would be beneficial to gold and silver, they typically move inversely to high, rates, right? So if rates move up, it's generally a bearish thing for gold and silver. And when rates move down, it's generally bullish. So we're going to get more clarity on rates in the next few minutes. In fact, as we jump into the FOMC statement as well as the press conference that will follow, you're going to get some big stuff here happening today, and I'm excited to go through it all with you guys. We got 433 people here. Just a reminder, like I said, in just a few minutes, I'm going to dip out of here and we're going to drop the link to where the stream is continuing on the trading battles. We count down to the big event between Chris Pulver and Blake Morrow. It's going to be so much fun. It's going to be great. NASDAQ, kind of flat here today. Again, the thing is, you can see the indices. They're all kind of coiled up right now. They've just been waiting for stuff like this. This sort of day has the potential, not the guarantee, but the potential to break us out one way or the other. And this is why we like news events around here. The market is frustrating when it's just choppy. A lot of times news events can potentially give us those follow-through moves that we really like. Right? Like this was a big announcement that China and the US had made some serious progress on trade negotiations, and the market just ripped for the next 1, 2, 3, 4, 5, 6. If you were in that move, there was 6 days of upside for the S&P 500. Right? So dollar, all these things have been very choppy recently. If you felt like it's been kind of difficult to trade recently, then you're not alone. A lot of people have been kind of frustrated by the chop. Well, a lot of the choppiness is because we've been waiting for a day like this, or a day like a clear signal on trade relations, or a clear signal from the Fed, and we may, not certainly, but we could get that today, and that's why today will be a pretty impactful one. What do I think about the CAD yen being the highest on the edge finder? I like the CAD yen. I like CAD in general. I'm bullish on the Canadian dollar at this time. I don't currently have an interest in adding CAD yen, although this is a great setup in my view. I like the idea of more upside for the Canadian dollar. I'm already long the CAD Swiss franc, which has been a boring but steady trade that I'm sitting in. I'm collecting positive swaps on this one and plan to continue doing so. I do think that there's upside for the Canadian dollar, and I have a couple different currency pairs that look attractive on the CAD side. So watching that pretty close. Dollar CAD also on the bearish side would be one I'm interested in. If we get more upside in the dollar CAD, like a move back up to like 1.38 or so, I may be looking for some shorts on this pair, anticipating further downside. I like that setup quite a bit on the short side for dollar CAD. So yeah, should be interesting. Should be interesting. Okay, guys, I'm going to go ahead and do it. We're going to switch over here to the trading battle. So let me just make sure you guys have the link. So I'm going to drop this in the chat. The stream is not over. We are just moving to the trading battle stream. I'm hosting a battle between Chris Pulver and Blake Morrow. We're going to be trading battle live. We're talking about taking positions on stream, gold, silver, dollar, indices, Forex pairs in general. We are going to be trading it all and giving our thoughts. And guys, combined, this is like 50 years of market experience coming on the stream in just a second. We've got Chris Pulver, he's got 20 plus years, Blake Morrow, 20 plus years, and myself, I've got about 10. So I got to get up there with them. But the point is, we're starting that battle here in just a second. Please do me a favor, follow me to this link here. I just dropped it. Stream is going to be starting over there in 4 minutes. So stay tuned. I'm going to dip out of here in the stream, and then the stream is starting back on the trading battle in just the next few minutes. Click this link in the chat right now to join me on that stream. I'll see you guys in just a second.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.